뉴욕나우. 안녕하세요. 월가의 시각을 전해드리는 뉴욕나우의 강영연입니다. 오늘은 노무라의 케니리 연구원과 이야기 나눠보겠습니다. 리 연구원은 미국의 경제정책, 시장 등 거시정책을 담당하는 분이고요. 현재 시장에서 이슈가 되고 있는 인플레이션, 공급망 혼란, 금리 상승 등 주요 현안에 대한 이야기 나눠보겠습니다.
Overall, the U.S. equity market has been supported by strong economic fundamentals. In Q4, I think U.S. broad indices can be choppy as earnings growth seems to have peaked and elevated inflationary pressures with slower economic growth momentum that we expect in upcoming months. For the U.S., we expect only a modest impact from slowing growth in China, as well as any potential financial conditions tightening through confidence channel, probably due to developments related to Evergrande. I think other issues such as ongoing debates among Democrats over the infrastructure bill and also the debt limit coming up could also induce more volatility. So unfortunately, I can't make exact forecasts for where the S&P 500 will go. I think given the momentum for the economic recovery is slowing, and also the given that input cost pressure from supply chain disruptions remain elevated, earnings growth might be slowing in coming months through Q4. I think that means the growth of the S&P 500 in Q4 could be somewhat limited. That's all I can offer at the moment. I think for earnings, I think I would agree that the performance in Q2 and resilient data on earnings through Q3 also have been driven by reopening activity in the US after a extended lockdown due to COVID-19. I think the peak is behind us at the moment, given the reports of rising input costs eating into profits. I think it seems reasonable to see slowdown in corporate profit growth that could be extended into 2022. Inflationary risks and companies reporting profit pressure. I think this all means there's some downside risk going forward. I think that is one of many factors. Also, there could have been some over-optimism over the summer before the Delta variant took hold in the US. But also there can be many uncertainties. Some companies could be worried about the development in China. Slower outlook for growth over there could be a factor that companies are responding to. But overall, we see some downside risk. That's a little bit of a topic. It seems to be that the disruptions are still ongoing. We have seen many reports of congestions at US ports around West Coast. Places like LA have been reporting a long line of container ships trying to unload. Also, semiconductor shortages have been affecting many categories of goods. Autos, consumer appliances have been all affected. Given the rise of Delta variant in many parts of the world, we think the supply chain disruptions will probably continue through possibly first half of next year. Again, things remain to be very fluid. And that could have an impact not only on US economic data, but also on companies' performances looking ahead into first half of 2022. I think the companies are still on a learning curve. Also, they continue to adapt to the ongoing changes, disruptions in the supply chain. When the US and China trade disruptions were really in full force a few years ago, I think companies were able to adapt quickly to imposition of tariffs by US and China. From that precedent, I think the companies still have the ability to adapt and reroute supply chain disruptions. Of course, I don't think there is a silver bullet, a solution that can change everything. But looking ahead, I think as vaccination rate improves around the world, subsiding Delta variant led new cases of COVID-19 can improve the situation. Yeah, I think there are many risks in the market going forward. I think the market has received a clear signal from the Fed around tapering. We have also a precedent from a few years ago when Fed began tapering in the previous economic cycle. In that regard, I don't think tapering is a threat. I think market has understood the signal from the Fed very well at this point. The prospect slower recovery in the US, I think the market participants are still understanding how resilient the US recovery will be following the surge in the Delta variant. The incoming data still suggests the demand in the US is still very healthy. I think there are many issues with supply constraints, holding back the US growth, potentially pushing back the recovery towards 2022. I think the market is still assessing where the US is headed. Another topic is a risk of slower growth in China as well. That can potentially affect markets' risk sentiment. The change in risk sentiment could affect equity sectors that have been previously associated with higher risk, such as tech, cyclical sectors could be more affected by potential risk in the market. I guess for the pandemic too, since we are not fully over the global pandemic, any development in the new variant besides Delta could also hurt the risk sentiment going forward. I think our view has been actually Q2 of 2023 rather than next year. The policy has been always to not have monetary policies working against each other. Since we expect the Fed tapering to come to an end after June of 2022, we think it's unlikely for the Fed to hike anytime before the end of tapering. Our assessment, as well as the Fed's, is that the inflationary pressure that we're seeing right now is still transitory. The latest CPI report that we saw especially showed a subsiding inflationary pressure on goods that have been previously affected by supply chain disruptions. Used auto prices, for example, show some decline in inflation. That all suggests that the Fed will be patient through 2022. The data so far seem consistent with our call, the first interest hike in the second quarter of 2023. Yeah, as I said earlier, I think the markets seem to have taken the message from the Fed very well. The message from the September FOMC meeting was very clear that the tapering will happen by the end of this year. We expect the announcement to come in November, and the actual implementation could come in December. There seems to be a risk of tapering starting a little bit earlier, possibly before December. The market reaction has been pretty tame. I think the recent volatility was more related to risk from China rather than the Fed. So in that regard, we don't really expect taper tantrum, as markets call, in any time this year. Yeah, I think markets will be paying a lot of attention to that. On infrastructure, I think the recent development indicates that the House Democratic leadership will aim to vote on the Bipartisan Infrastructure Investment and Jobs Act potentially this week. We have been expecting some form of Democrat-only approach as well. Yeah, the uncertainty is still there given there aren't that many days of the week left. We'll have to continue to monitor the debate in DC. The markets seem to have priced in positive impact from potential passage, the bill. The passage of this bill could have a positive development, positive impact for some obvious sectors such as constructions, perhaps industrials. Also, improvement in risk sentiment could affect other areas that can be associated with higher risk. I think at least near the time of the announcement, those sectors could see some positive impact. I think it seems the markets are closely tracking the ongoing debates over the deal already. And to some degree, I think the impact could be limited, given that many market participants have already been, to some degree, pricing in any positive impact. I would note that the impact of the final form of the bill on the economy would be spread out across many years, and the economic impact will not be front-loaded. That means most likely we'll see a gradual impact over the economy, which will be spread out over many years. So it would be a bit premature to assume something as robust as the tax cuts, for example, that we saw during the Trump era. I think we're still comfortable with our view that the upside inflationary pressure is still transitory. We have seen, the outlook for the US inflation is a bit complicated. On one hand, there are sectors that were severely affected by the pandemic. So we think subsiding inflation of certain goods like used vehicle prices, that's going to wane over coming months, lowering the inflationary pressure currently. Also, the rebound in certain industries such as rent, for example, in urban cities, could turn out to be more forceful than we thought. I think the risk overall through the first half of next year is towards the upside, as the prices of services that have been previously held back by COVID-19, as they pick up, I think we could see some strong readings over the coming months through the first half of next year. But after all these factors are transitory. I think the markets are still processing this information. We don't think the markets are complacent at this point. So in that regard, we don't expect a sharp correction just by a few upside surprise in inflation reports. There could be some short-term reaction, near-term volatility in response to some strong readings. But ultimately, we think markets are well-positioned to handle inflation surprises over coming months. That's a very valid question. I think that's why a lot of market participants, as well as us, are assuming some upside risk to inflation. Ultimately, as the economic recovery slows, I think the inflationary pressure will wane as well. Of course, we'll have to monitor the incoming data. The slower growth will still have the power, the potential to bring inflation down over the medium-term horizon. Not necessarily. I think a big part of the inflationary pressure that we've been seeing this year has been due to transitory factors. Things that have been going up were due to supply chain disruptions, input shortages, etc. So I wouldn't necessarily attribute a slowdown in inflation to a slower economic growth. I would rather describe it as the inflationary pressure coming back to normal. So the US inflation has been running below 2%, the Fed's inflationary target of 2% for many years, even though the US economic growth was very strong before the pandemic. The US inflation rate was below the Fed's target for a while. Based on those precedents, the the conventional economic wisdom of equating low inflation to weak economic growth doesn't necessarily hold anymore. And the slowdown in inflation over the medium term would not necessarily be associated with economic slowdown. It should be described more as the inflation coming back to normal as supply chain disruptions disappear. I guess as an economist myself, I look at economic fundamentals. Looking at strong economic fundamentals, elevated equity prices are not too far-fetched. I think the US economic recovery has been very strong, and that was also reflected in strong earnings in past quarters. I think market participants, of course, pay a lot of attention to any developments related to US fiscal policy that has a potential to affect US economic growth trajectory a lot. I think looking ahead, markets will be paying a lot of attention to China, as they should. The development with Evergrande, the slowdown in the property sector will likely get a lot of market attention. I think our baseline expectation is that the spillover into the US market will be limited. Of course, there will be volatility based on any short-term developments. We don't expect a heavy impact from developments in China to the US markets. I think we are still forecasting strong recovery over coming quarters, although it wouldn't be as strong as the initial recovery since the pandemic. Overall, the data have been pretty positive. Non-farm payroll employment, for example, has been averaging around 750,000. That's still a very good print. 3-month moving average, 750,000 is consistent with improving labor market. Incoming manufacturing survey data overall has also shown resilient economic recovery. Although there are some risks related to strong inflation, the companies in the US have been operating pretty well given elevated demand in the US. In that regard, we are still comfortable with our view that the recovery will continue. Labor markets will continue to recover as well. And we still expect strong economic growth in the near term.